I'm Professor Indra Abhisekar. I will go through a quick illustration of preparing the statement of cash flows. Let's say it's the first year of operations and it's 2022, 30th of June 2022 is the year end. We have got the income statement with revenue, expenses, and profits. And given the information, company pays no tax. And the balance sheet at 30th of June 2022 is shown as non-current assets with the land 10,000, current assets cash 42,000, current liabilities 0, non-current liabilities with an interest-free loan of 20,000, equity share capital of 30,000, and then retained earnings which are earned during the year as shown in the income statement of 2,000. So using this information, we'll prepare the statement of cash flows. We require the current year income statement and the current year balance sheet and the previous year balance sheet, but we don't have a previous year balance sheet because this is the first year of operations. And we prepare the statement of cash flows for the year ending 30th of June 2022. There are two methods to prepare cash flows. We start with the direct method and then we look at the indirect method. So the cash flows from operating activities arise from the revenue and then the any revenue that's not earned as cash are recorded as accounts receivable. When we look at the balance sheet, we don't have accounts receivable, which means the revenue is fully earned as cash. So cash received from customers is $10,000. Expenses is $8,000. And when we look at the balance sheet, we see that the current liabilities is 0, which means there's no accounts payable. All the expenses to the suppliers are paid immediately as cash, and cash paid to suppliers becomes 8,000. So the net cash flows from operating activities is the difference between 10,000 and 8,000 is $2,000. Then we get to the cash flows from investing activities. We can see that under the non-current assets, there's $10,000 of land. It has increased $10,000. The transaction has taken place during the year. We take it as purchase of land as been paid out of cash, and that's $10,000. And net cash flows from investing activities, therefore $10,000, which is a cash outflow. The cash flows from financing activities can arise from long-term liabilities and also from the shareholders' equity. The non-current liabilities, there's an interest-free loan that's taken, which means there's $20,000 of cash coming in. So taking an interest-free loan, $20,000, and there has been a share issue of $30,000, which has brought in cash because we're told that all transactions were on cash as additional information, and the issue in shares is $30,000. Net cash flows from financing activities, therefore, is 20,000 plus 30,000, 50,000. When we add up the operating activities, financing activities, and investing activities, we get a total of 42,000. Cash at the beginning of the period, because it's first year of operation, is 0, and cash at the end of the period is 42,000. And the 42,000 that we see, cash at the end of the period, should tally with the balance sheet current assets cash of 42,000. We'll now look at the indirect method. Under the indirect method, the only difference is on the cash flows from operating activities, but other two, cash flows from investing activities and financing activities, are identical. On the operating activities, we start with profit of 2,000. We had a revenue of 10,000, expenses of 8,000, a profit of 2,000. So we start with profit of 2,000. So profit of 2,000, and then there's non-cash items adjustments for such as depreciation expense or provisions expense, but they are not there in this income statement, therefore zero. And there's no adjustment on the current assets and current liabilities except for cash, because cash is shown separately below in this statement, the movement of cash, which we determine in detail, but we have the beginning figure and the end figure which we are going to prove. So the current liabilities, the movement of current liabilities is zero, so which means profit in this instance is equal to cash flows from operating activities. So under the direct method, the cash flows from operating activities was 2,000, and under the indirect method, cash flows from operating activities is also 2,000. Cash flows from investing activities are identical as in the direct method, and cash flows from investing activities are identical as the direct method. And the cash movement, net cash flows for the period is 42,000. Cash at the beginning of the period is 0, and cash at the end of the period is 42,000. Under the indirect method and direct method, the cash at the end of the period should be 42,000. That 42,000 should match with the balance sheet of cash position of 42,000. We look at the following year. In the following year, second year of operation, this is 30th of June 2023, we have the revenue and expenses, and then the profit made. Revenue is 20,000, expenses 15,000, profit for the period is 5,000, and we are given additional information as company pays no tax. And then we are also given the balance sheet for the previous year that we already had, and then the current year as well. We can see that the non-current assets of land has increased due to a purchase, and the current assets of the cash has increased to 46,000. But in our cash statement of cash flows, we have to show that 46,000 is the reconciling number with the balance sheet 46,000 final cash balance. Here we are also finding accounts receivable of 4,000. That means some of this revenue has been uncollected and been recorded as accounts receivable. And then there's current liabilities of 3,000, which means there's some suppliers to whom the company has not yet paid. So there's cash inflows of 3,000, and for the accounts receivable, there's cash outflows or cash not received of 4,000, and on the current liabilities, cash not paid is 3,000. Non-current liabilities, interest-free loan has not changed, it remains same, and the equity share capital has increased with a further issue of 5,000, has increased to 35,000. Retained earnings are equal to 7,000. That's from the previous year's 2,000 retained earnings and the current year's profit 5,000, that adds up to 7,000. We look at the statement of cash flows for 30th of June 2023 under the direct method. Cash flows from operating activities from customers, it is 20,000. We're supposed to receive as cash, but because there's accounts receivable, what we received was 20,000 less 4,000, which is 16,000. And cash paid to suppliers is we're supposed to pay 15,000 worth of cash, but we did not pay 3,000, which means cash paid to suppliers equal 15,000 less 3,000, and that's 12,000. Net cash flows from operating activities therefore equals 16,000 less 12,000 and that equals to 4,000. Cash flows from investing activities. There has been a purchase of land, additional block of purchase of 5,000, purchase of land, and we're not given any additional information to be otherwise, like there has been a sale of land and a purchase of land. So we're making underlying assumption here that there has been a purchase for land. And that net cash flows from investing activities is a cash outflow of 5,000. Cash flows from financing activities. The interest-free loan amount has not changed, so there's no inflow or outflow there. But issuing cash, the company has received cash of 5,000, and that 5,000 is recorded here. With the underlying assumption, these transactions are conducted in cash because there's no information to the contrary. Net cash flows from financing activities therefore equals $5,000. Net cash flows for the period from operating activities, investing activities, and financing activities when we add together equals $4,000. Cash at the beginning of the period, we can see from the previous balance sheet, is 42,000, and when we add the net cash flows for the period, we end up with cash at the end of the period of 46,000. The 46,000 of cash at end of the period should equal to current assets cash in the balance sheet of 46,000. We'll now look at the indirect method. Under the indirect method, the only difference is the cash flows from operating activities, with investing activities and financing activities being identical. Cash flows from operating activities under the indirect method starts with profit. The profit is revenue less expenses, 20,000, revenue less expenses 15,000, profit is 5,000. We start with 5,000 profit. There are no non-cash items adjustments, so therefore we don't have to do anything. But the accounts receivable has now increased from 0 to 4,000. When accounts receivable increases, accounts receivable means we have not received cash. That means we have to deduct that equivalent to a cash outflow. So therefore we make adjustment of less that decreases the profit situation to when we are arriving at the cash situation. The current liabilities shows that there's $3,000 worth of current liabilities. That means the current liabilities from the previous year to the current year has increased by $3,000 because in the previous year we did not have any current liabilities, but this year we do have current liabilities, and that current liabilities are holding the cash without paying. That means that's equivalent to a cash inflow, so we add that into the profit situation to come to the cash situation. And when we add all them together, we come up with net cash flows from operating activities equal to 4,000. The net cash flows from operating activities under the indirect method should equal the direct method of 4,000. Cash flows from investing activities and cash flows from financing activities are identical, and the net cash flows for the period we add from the cash flows from operating activities, investing activities, and financing activities. And when we add them together, we come up with $4,000. Cash at the beginning of the period coming from the previous year is 42,000, and we need to prove that the cash at end of the period is 46,000. And when we add up the net cash flows for the period to the beginning of the period, we come up with cash at end of the period of 46,000.